Fort Lauderdale, Florida, May 2021. A 2021 Lagoon 46 sailing catamaran changes hands for $1.18 million. The marine survey was clean. The broker was confident. The charter management company had projections on the table, $96,000 in gross annual income, enough to cover most of the operating costs and nearly half the financing. The buyer wired the money the same week. 3 years later, that same catamaran is listed for $519,000 on Yacht World. 3 brokerages declined the listing because the asking price still exceeds what the market will bear. The outstanding loan balance sits at approximately $820,000. The insurance carrier sent a non-renewal letter 18 months ago, citing the vessel's commercial charter history and its location inside the hurricane belt. The owner had one option left: find a surplus lines carrier willing to write a policy at $28,000 per year, 3 times the original premium, or sail the boat uninsured. That was the cheap part. This video is about the financial structure behind that moment, a layered system with 5 moving parts and 7 specific sailing catamarans where every single part fires at once. These are not obscure boats. The Lagoon 46, the Lagoon 50, the Leopard 50, the Fountaine Pajot Aura 51, the Fountaine Pajot Alegria 67, the Bali 5.4, and the Sunreef 60 were the most sought-after, most heavily marketed sailing catamarans on the planet between 2017 and 2022. Builders could not keep up with orders. Buyers paid prices no one had ever paid before. Charter companies promised income streams that would transform the math of ownership. The system collected from all of them. Picture yourself in that broker's office in 2021, before any of this became clear. You have spent 2 years reading the forums, watching the videos, attending the boat shows. You have done the calculation. You sit at the espresso bar in the Marina Lounge in Tortola, the air thick with salt and diesel, and the particular optimism of people who have decided to change their lives. The charter representative opens the laptop and shows you the numbers. $8,000 a week in high season. 42 weeks of potential bookings. A modern catamaran with twin cabins aft, a vast trampoline between the bows, the kind of offshore stability that a 40-foot monohull cannot match. The pen is above the contract. The dock lines are singing in the afternoon trade wind. And somewhere below all of this, beneath the projected income tables and the lifestyle photography, a ledger is being opened that you are not yet invited to read. The numbers, what they mean, and what they hide are for later. For now, the dream is real. The industry's own data tells a precise story. Annual operating costs for a sailing catamaran valued above $600,000 run between 10 and 15% of the hull value every year before financing or depreciation. According to Marsh McLennan Agency's yacht market analysis, for a $1.2 million Lagoon 46, that is $120,000 to $180,000 consumed in 12 months before the first charter booking is confirmed. Then came Hurricane Ian. In September 2022, Ian made landfall near Cayo Costa, Florida, with sustained winds of 150 miles per hour and storm surge of 12 to 18 feet along the southwest Florida coastline. According to Gallagher Charter Lakes, yacht-specific damage in Florida alone exceeded $1 billion from that single storm. Swiss Re Institute classified Ian as the second largest insured loss event in United States history. After Ian, carriers who had already been retreating accelerated the exit. Some reported reinsurance cost increases of up to 30% for the following year. Lloyd's of London had been moving in this direction since 2017. According to Risk and Insurance magazine, in the 9 months following Hurricanes Harvey, Irma, and Maria, Lloyd's recreational marine syndicate capacity contracted by 70 to 75%. By 2021, 5 named carriers, American Reliable, Brit, Falvey, Ironshore, and Pantaenius, had exited the yacht market entirely. Boat US, operating under GEICO Marine Insurance Company, is the largest recreational boat insurer in the United States. As of 2022, its application system carries a categorical exclusion for all multi-hull sailboats. Not specific models, not specific ages, all of them. A 2020 Lagoon 46 that sold new for approximately $1.2 million now achieves $450,000 to $500,000 on the open market, a loss exceeding 50% of its original value within a single ownership cycle, according to market data published by Catamaran Guru in December 2025. These 5 benchmarks, carrier withdrawal, catastrophic hurricane exposure, categorical insurer exclusion, depreciation collapse, and maintenance documentation standards, form the backbone of the real catamaran ownership equation. They are not worst-case scenarios, they are the industry's own consensus. Michael Hartman started with a clean survey, a signed charter agreement, and a $1.18 million wire transfer. The first renewal told a different story. Hartman's 2021 Lagoon 46 generated $72,000 in gross charter income in its first year, $24,000 below projection. A competing charter fleet had expanded at the same British Virgin Islands base, splitting available bookings. Against that $72,000 stood $177,000 in documented operating costs, insurance, dockage, regular maintenance, 2 engine services, and 2 haul-outs required by the charter agreement. Add $84,000 in first-year financing interest, and the net outflow in those 12 months reached $189,000. By the third year, the boat's assessed value had declined to approximately $650,000 as post-pandemic catamaran supply pushed prices down across Caribbean and Florida markets. The loan balance remained near $820,000. To exit, Hartman would need to write a check for the difference or negotiate a short sale. During year 2, a dockline failed during a tropical system passing through the British Virgin Islands. Minor hull damage resulted. Hartman discovered a $22,000 windstorm deductible buried in the policy renewal, a new term inserted when the carrier reassessed the book after Hurricane Ian. The claim was partially honored. The deductible was not. The first mechanism was in full operation, EX charter depreciation. The moment a sailing catamaran enters commercial use, its resale value declines not just through wear but through market perception. On a $1.2 million asset, that discount compounds annually, independent of any physical damage. There are 5 mechanisms in this system. For the 7 models on this list, all 5 fire simultaneously. The first mechanism started quietly at Lloyd's of London, years before anyone noticed. In 2015, according to data reported by Tradewinds and Superyacht News, Lloyd's marine portfolio collected approximately £150 million in yacht premiums and paid out approximately £210 million in claims, a loss ratio of 140% in a year with no major storms. After hurricanes Irma and Maria devastated charter bases across Tortola, St. Martin, and Antigua in 2017, the arithmetic became impossible to ignore. Within 9 months, 75% of Lloyd's recreational marine syndicate capacity had exited the market. Brit Global Specialty, Lloyd's Syndicate 2987, ended its yacht insurance business in August 2018. 5 to 7 additional syndicates followed within weeks. The second mechanism arrived in September 2022 on the southwest coast of Florida. Hurricane Ian's $1 billion in yacht-specific damage produced a specific response. Boat US formalized its categorical multi-hull exclusion. Progressive Insurance set a $250,000 hard ceiling on coverage for vessels kept in hurricane-exposed areas, blocking every boat on this list from the country's 2 largest consumer marine insurers simultaneously. The third mechanism is Geographic. Most yacht underwriters require catamarans to be north of 30.5 degrees north latitude or south of 10 degrees north latitude between July 1st and November 1st. The British Virgin Islands sit at 18.4 degrees north. Florida sits between 25 and 31 degrees north. Compliance means repositioning the boat at owner expense for 5 months of the year. For boats locked into Caribbean charter agreements, repositioning violates the management contract. According to Casey Insurance Group's market data, a $600,000 hull in a high-risk hurricane zone carries an estimated annual premium of $25,000 or above. The same hull in a low-risk geography carries approximately $10,000. In documented cases reported on Sailing Anarchy in 2024, boat U.S. customers received mid-cycle non-renewal letters citing vessel length exceeding 40 feet, on policies held and paid without incident for years. Under U.S. insurance law, a non-renewal requires less advance notice than a cancellation and triggers fewer consumer protections. The exclusion is not a rate adjustment, it is a categorical exit, executed mid-policy. The fourth mechanism lives in the maintenance record. According to an analysis published in the Yacht Boy newsletter in March 2026, underwriters now require documented service records for seacocks, through hull fittings, electrical panels, bilge pumps, and standing rigging intervals. A hull survey that declares the vessel structurally sound is no longer sufficient. If the documentation is absent, the underwriter declines the risk regardless of what the survey says. All 7 models on this list were deployed at scale in commercial charter fleets. The moorings introduces 150 to 200 new catamarans annually and phases out a comparable number each year. Charter operators maintain boats to commercial standards, but the paper trail travels with the operator, not with the hull. When the boat changes hands, the paper trail stays behind. The fifth mechanism is what happens when mechanisms 1 through 4 run simultaneously across an entire production cohort. The X-charter pipeline, built during the 2020 to 2022 buying surge, is barely halfway through its discharge cycle. Charter fleets retire boats after 5 to 7 years of commercial service. The bulk of the 2020 and 2021 purchases will reach the used market between 2025 and 2028, against a buyer pool that now has access to the same documentation standards the underwriters apply. For these 7 models, the documentation gap is not a quirk of individual neglect. It is structural to how the pipeline works. Jennifer Calloway entered catamaran ownership through a different door. In February 2020, she purchased a 2020 Leopard 50 in the British Virgin Islands through a charter management program at $968,000. In year 1, gross charter income was $85,000. The charter management company retained 45%, $38,250, before Calloway saw her first payment. Against the remaining $46,750 stood 2 engine service calls totaling $14,200 and a standing rigging inspection with partial replacement at $17,800. Her marine surveyor noted those costs were twice the cycle of a privately operated vessel of the same age. Commercial charter use accelerates maintenance intervals. The agreement disclosed this near the end of Section 9. Net annual income after management fees and accelerated maintenance was $14,750, compared to $90,000 in annual operating costs. In year 3, the admitted carrier declined renewal. A surplus lines quote arrived at $28,000 annually. Calloway requested early exit from the management agreement. The contract required 90 days notice and triggered a buyback clause, allowing the charter company to repurchase the vessel at a formula price, derived from an internal depreciation schedule, not from the open market. The formula price came in at $610,000. A comparable Leopard 50 listed on Yacht World at the time, $795,000. 2 owners. One paid $1.18 million for a private dream. The other paid $968,000 for a mathematical hedge. Both are now unable to insure at the original premium, unable to exit without a financial penalty, and competing against hundreds of nearly identical hulls on a market where only 10% of completed transactions clear the $1 million mark. The system extracted from both of them, and from every buyer in between. 3 things protect you from this outcome, and each one takes less than an hour. Before depositing on any used sailing catamaran over $500,000, contact 3 specialist marine carriers directly: Markel Marine, Concept Special Risks, and Gallagher Charter Lakes. Give them the hull identification number, the home port, and the full charter history. Ask each one to confirm in writing whether they will issue hull and liability coverage at standard terms. Do this before the deposit clears. A boat that cannot be insured through a specialist carrier at a reasonable premium is not a boat at a discount. It is a liability at a purchase price. The hull survey is the second gate. Do not accept it as proof of insurability. Request the original maintenance logs from whoever operated the vessel commercially. Seacocks, through hull fittings, electrical panels, bilge pump service records, standing rigging replacement intervals. If the seller cannot produce documentation covering 3 years of continuous commercial operation, the underwriter cannot price the risk, and you inherit the gap at the first renewal. Ask one question before signing any management contract. What is the formula in the buyback clause? And what were the last 3 boats' actual exit prices compared to their original purchase prices? A company confident in its own projections answers this on the same call. One that refers you to legal counsel has already answered. The catamaran market transferred an extraordinary amount of capital between 2017 and 2022, from buyers who trusted the projections to the entities that built the products around them. The insurance market did not create the trap. The insurance market stopped pretending the trap did not exist. The ledger was always open. Now you are reading it.